your savings just lost 2.8% of its value in 7 days. Not because of inflation, not because of a recession, but because of something far more unusual happening in global markets right now. The dollar just experienced its steepest weekly decline since April 2025's Liberation Day market turmoil, and three of the world's most powerful central banks are scrambling to respond. If you hold dollars, euros, or yen, or if you're invested in international markets, the next 30 minutes could be the most important financial education you receive this year. Here's what's actually happening behind the headlines. Let me start with the facts as they stand today. The US dollar index, which measures the dollar's strength against 6 major currencies, is hovering near 4-year lows. Since last Wednesday, it's dropped nearly 2.8%. That's not just a number on a chart. That's real purchasing power evaporating from dollar-denominated assets worldwide. Meanwhile, the euro has surged past $1.20 for the first time since 2021. The British pound hit 4.5-year highs. The Japanese yen is posting its strongest monthly performance against the dollar since April 2025. And gold has been shooting up as investors flee to safety. This isn't normal market volatility. This is a coordinated shift in global capital flows driven by something deeper, a crisis of confidence. Now, before we go further, let me be clear about what this commentary is and isn't. This is not about politics. This is not about taking sides. This is about understanding the mechanics of what happens when the world's reserve currency experiences a confidence shock and what that means for your financial decisions going forward. So let's break down exactly what's happening, why it matters, and most importantly, what you can do about it. First, we need to understand how currency markets actually work, because this isn't taught in most schools, and it's essential context for everything else we'll discuss. Currencies don't exist in isolation. They trade in pairs. When we say the dollar is falling, what we really mean is that it's losing value relative to other currencies. The euro strengthening to $1.20 means it now takes $1.20 to buy 1 euro, up from previous levels. But here's what makes the dollar unique. It's the world's reserve currency. Approximately 60% of global foreign exchange reserves are held in dollars. International trade, especially in oil, commodities, and major goods, is predominantly denominated in dollars. When foreign companies want to do business internationally, they often need dollars to do it. This creates what economists call structural dollar demand. Countries and companies around the world need dollars simply to function in the global economy. This demand has historically kept the dollar strong, even when US economic fundamentals might suggest otherwise. So when the dollar falls nearly 3% in a single week, despite the US economy growing at an estimated 5.4% in the fourth quarter of 2025, well above the 4.4% from the previous quarter, something unusual is happening. The dollar is falling not because the US economy is weak, but because investors are concerned about something else entirely: policy uncertainty and confidence in US institutions. Let me explain what I mean by that. Currency strength rests on 3 fundamental pillars. Pillar 1, economic fundamentals. This includes GDP growth, employment levels, productivity, and trade balances. By this measure, the US should have a strong dollar. The economy grew 5.4% in Q4 2025. That's exceptional growth for a developed economy. The asset markets are performing well. The economy is, in the words of one analyst, in very good shape. Pillar 2, monetary policy and central bank credibility. This is where things get complicated. Investors need to believe that the central bank can effectively manage inflation and maintain stable monetary policy. When there are fears about central bank independence, about whether the Federal Reserve can make decisions free from political pressure, that pillar starts to crack. The document mentions fears over Fed independence as one factor contributing to dollar weakness. This is significant. The Federal Reserve's credibility as an independent institution has been one of the dollar's greatest strengths for decades. Pillar 3, political and policy stability. Currency traders need predictability. They need to be able to model outcomes and assess risks. When policy becomes what analysts are calling erratic, particularly regarding trade and international diplomacy, it introduces uncertainty premium into currency valuations. The report specifically cites investor concern over erratic approach to trade and international diplomacy and huge increases in public spending as factors driving dollar weakness. Here's what's fascinating. Pillar 1 is solid. The US economy is strong, but pillars 2 and 3 are showing stress fractures, and that's enough to trigger what we are seeing, a classic flight to quality away from the dollar, except the dollar usually is the quality asset. This inversion, where investors are fleeing from the traditional safe haven, tells us something profound about market psychology right now. Now, here's where this gets really interesting, because currency movements never happen in isolation. They trigger cascading effects across the entire global financial system. Effect 1. European concerns. The euro strength to $1.20 is causing serious concern at the European Central Bank. 2 ECB officials have now publicly stated that euro strength could influence monetary policy. Austrian Central Bank Governor Martin Kocher told the Financial Times the ECB may have to consider another interest rate cut if euro strength affects inflation outlook. Bank of France Governor François Villeroy de Gallo said policymakers are closely monitoring the appreciation of the euro and its potential impact on lower inflation. Why does this matter? Because a strong euro makes European exports more expensive for the rest of the world. If you're a German car manufacturer or a French wine producer, your products just became more expensive for American buyers. That could slow European economic growth and put downward pressure on inflation, which is already low in Europe. The irony here is profound. Europe didn't ask for a stronger currency, but they're getting one anyway because of dollar weakness. Effect 2. Japanese complications for Japan. The situation is even more nuanced. The yen surged over 1% to a 3-month high of 152.10 per dollar. Japan has been grappling with yen weakness for years, so you might think they'd welcome this strengthening. But here's the complication. Prime Minister Sanai Takaichi is basing her snap election campaign, set for February 8th, on expanded stimulus measures. Stimulus typically weakens a currency, yet the yen is strengthening despite this, which tells us the dollar weakness is overpowering domestic Japanese policy. The document notes speculation about joint Japanese-US official intervention to support the Japanese currency. This is extraordinary. Official currency intervention is rare and signals serious concern from policymakers. Effect 3. Gold surge. Gold shooting up alongside other currencies is the classic safe haven move. When investors lose confidence in fiat currencies, especially the dollar, they often move to gold as a store of value that's not tied to any single government or central bank. This isn't just about diversification. This is about fundamental questions of trust in the dollar system. What we're witnessing is a synchronized global response to dollar weakness. It's not just one country or one market reacting. It's the entire interconnected financial system recalibrating expectations. Kyle Roder, a senior market analyst at Capital.com, called this a crisis of confidence in the US dollar. That's strong language, and it's important we understand what that actually means. Confidence in a currency is built over decades and can be damaged in weeks. It's built on consistent rule of law, predictable policy framework, institutional independence, fiscal responsibility, international cooperation. When any of these elements appears threatened, markets respond immediately, because currency trading is a forward-looking exercise. Traders aren't betting on where things are today. They're betting on where things will be in 6 months, a year, 5 years. The document notes that when President Trump was asked whether the dollar had declined too much, he said the value was great. Traders interpreted this as a signal to intensify dollar selling. Why would a president saying the dollar value is great cause more selling? Because markets heard we're not concerned about dollar weakness. And if the administration isn't concerned, that removes a key potential support mechanism for the currency. This is the difference between market reality and political messaging. In currency markets, words matter as much as actions, sometimes more. Roder noted, it would appear that while the Trump administration sticks with its erratic trade, foreign and economic policy, this weakness could persist. This is the key word, persist. This isn't expected to be a temporary blip. Analysts are modeling continued dollar weakness as long as policy uncertainty continues. For investors, this changes everything. A temporary currency fluctuation is one thing. A persistent trend is something you need to position for. Let's address what might be the most confusing aspect of this entire situation. How can the dollar be weak when the US economy is so strong? The Atlanta Fed's GDP Now indicator estimates 5.4% growth in Q4 2025. That's remarkable. The economy grew 4.4% in Q3, which was a two-year high. Asset markets are performing excellently. By traditional metrics, this should support a strong dollar. Societe Generale's head of FX strategy, Kit Jukes, captured this paradox perfectly. The odd man out is the dollar, in the sense that there's some stubbornness with US inflation. The economy is in very good shape. The asset markets are doing great. So what gives? This is the clearest evidence that currency strength is about more than just economic fundamentals. It's about trust, confidence, and predictability. Think of it this way. If you had a business partner who was extremely profitable, but whose decision-making became increasingly unpredictable, would you want to hold more of their company's stock or less? The business might be making money, but the uncertainty premium would cause you to reassess your position. That's what's happening with the dollar right now. The business is strong, but the uncertainty premium has increased dramatically. Jokes also mentioned some stubbornness with US term inflation. This is important. Despite strong growth, inflation remains a concern. Normally, strong growth with inflation concerns would lead the Fed to raise interest rates, which would strengthen the dollar. But the Fed is expected to make no changes to rates until at least mid-year, after Chair Jerome Powell steps down. This policy paralysis, or perhaps policy prudence depending on your perspective, removes another potential support for the dollar. Now let's talk about what this means for you concretely and practically. Takeaway 1. Understand your currency exposure. If you hold assets denominated in dollars, you have direct currency exposure. If the dollar continues to weaken, your purchasing power for imported goods decreases. Your international travel becomes more expensive. Foreign investments become relatively more valuable. If you hold foreign assets, European stocks, emerging market bonds, international real estate, you're benefiting from currency translation effects, as those currencies strengthen relative to the dollar. Action: review your portfolio and understand how much currency exposure you have. This isn't about changing everything overnight. It's about being aware. Takeaway 2, diversification, takes on new meaning. Geographic diversification isn't just about different markets. It's about different currencies. A portfolio that's 100% dollar denominated has concentration risk that may not have been apparent before. Consider whether some exposure to euro-denominated assets, yen-denominated assets, or precious metals makes sense for your situation. This isn't a recommendation to abandon the dollar. It's about balance. Takeaway 3. Watch the Fed. The Federal Reserve's next moves will be critical. The document notes a Fed policy decision was expected, with no rate changes anticipated until at least mid-year after Powell's departure. The transition in Fed leadership will be a crucial moment. How the new chair establishes credibility, communicates policy direction, and maintains independence will directly impact dollar strength. Action: pay attention to Fed communications. Not just the rate decisions, but the language around independence, inflation targets, and policy frameworks. Takeaway 4. Policy stability matters more than ever for business owners and investors. With international exposure, policy predictability has become a premium consideration. Companies are factoring currency volatility into their hedging strategies and pricing models. If you run a business with international suppliers or customers, review your currency hedging strategies. The cost of hedging may have increased, but the cost of not hedging in a volatile environment could be higher. Takeaway 5. This is a learning moment. Regardless of what happens next with the dollar, we're witnessing a real-time lesson in how global currency markets function, how confidence impacts valuations, and how interconnected our financial system truly is. Understanding these mechanics makes you a more informed investor, a more sophisticated business owner, and a more educated citizen. The bigger picture: this situation illustrates why financial literacy matters. The people who understand currency dynamics will make different decisions than those who don't. They'll position their portfolios differently, price their products differently, and time their international transactions differently. Education creates opportunity, especially during periods of volatility. Here's what we know for certain. The dollar has experienced its steepest weekly decline since last April, losing nearly 2.8% in 7 days. This happened despite strong U.S. economic growth of 5.4% in Q4 2025. European and Japanese central bankers are responding to the resulting currency strength in their regions. Gold and other safe haven assets are rising as investors reassess risk. This is driven not by economic weakness, but by what analysts are calling a confidence crisis, concerns about policy predictability, institutional independence, and fiscal trajectory. What happens next depends on factors that are still unfolding: Fed leadership transitions, policy directions, international responses, and whether the structural demand for dollars reasserts itself. But here's what you can control: your awareness, your understanding, and your positioning. The currency market just sent a signal. Whether you're an investor, a business owner, or simply someone who wants to understand the financial forces shaping our world, that signal deserves your attention. Stay informed, stay diversified, stay adaptable. And remember, in financial markets, yesterday's certainties can become tomorrow's questions. The dollar's strength was taken for granted for decades. That assumption is now being tested in real time. How this test resolves will shape the global financial landscape for years to come. Still your guy Innocent? Don't forget to hit the subscribe button, comment, like, share, and turn on your notification button to receive more financial news and commentaries. See you on the next one.